S&P, the Nasdaq down 0.6%. The Nasdaq 100 year to date absolutely flying. We'll pick up on that in a moment. There's your opening bell, switch at the board and get to the bond market. Yields look a little something like this on a 10-year. Your 10-year yield doing nothing at 350.97. Some important PMI data coming up in about 15 minutes. We'll break that down with Mike McKee. Euro dollar 108.63. The composite PMI out of the Eurozone above 50 for the first time in expansionary territory going back to June. Euro dollar still negative by about 0.1% on the day, and just to round things out for you, crude just short of 82. We're positive about 0.1% or so. The opening bell then, we're a little bit lower, about 20 seconds into this. We are down by 0.5% on the S&P 500. On the Nasdaq, we're down about 0.5% also. One stock to watch at the open is 3M, delivering a downbeat outlook and announcing plans to reduce its workforce. The CEO, Mike Roman, saying the following: we expect macroeconomic challenges to persist in 2023. We will reduce approximately 2,500 global manufacturing roles, a necessary decision to align with adjusted production volumes. Abby has more on the story. Hey, Abby.
Hey, John. Well, yes, a rough morning for 3M, and indeed having its worst day right now since 2022, August of 2022. What's really interesting, we have a lot of circuit breaker issues at the NYSE right now, it appears, based on my breaking news, my news headline. And this stock on the open at one point down 16%, its worst day since 1987. I don't know if that'll hold, but yes, a bad day, a bad year, and a bad 5 years for 3M. You and Kaylee earlier were talking about the layoffs, 2,500 manufacturing jobs cut. That is certainly a piece of it, but it also has to do with the earnings miss. A messy quarter, really. Sales basically in line, and then, of course, that weak outlook, also a piece of what's going on. The CEO mentioning those macro headwinds. Now, this company, of course, makes everything from Post-it notes to surgical supplies. Healthcare is the only segment, though, John, that is growing. Healthcare growing by 20%. Consumer, safety, industrial, transportation, electronic, all down. So net, we are looking at 2% growth. Not great for this conglomerate. Meanwhile, the company is facing liabilities all over the board relative to their military earplugs, plus on carcinogenic fire foam. So over the last roughly 4 years, this stock down about 44%. Over the last 5 years, down about 50%. Really underperforming, as you can see, the industrial sector, which is up close to 50%. So 3M's woes continue. It doesn't really seem like there's a bright spot for this stock at all right now, John.
That stock getting absolutely hammered. Abby, thank you. Let's stick with earnings. Some mixed results from the home builder, D.R. Horton, this morning. The home builder topping estimates as the C-suite delivers a warning on the challenging environment, saying the following: we've seen a moderation in housing demand caused by significant increases in mortgage interest rates and general economic uncertainty. Kelly Lights has more. Hey, Kaylee.
Hey, John. Yeah, they did manage to deliver that beat on the bottom line, which is likely why we see the stock up about 2.3% at the opening bell. But just to put that profit into context, it's down about 41% sequentially from the prior quarter and down 13% year on year. So yes, a beat, but we still have to keep that in mind. And where you're really seeing the pain in the housing sector showing up is in their purchase contracts. Those were down about 38% from a year earlier. So those quarterly orders actually missed expectations. And on the call, executives did warn those pressures may persist. They said expect revenues to drop in 2023 along with prices and gross margin, because they are still offering incentives to drive buyer traffic. Those incentives, like price cuts and mortgage rate buy downs, do come at a cost and weigh down margins. The company's gross margin on home sales fell to 17.5%, down from 21.2% a year earlier. But if there is a bright side to look at, John, it's that mortgage rates aren't as high as they were. The average 30-year rate has fallen from 7.4% back in November to just about 6.5% net now, and that has led to improved home builder sentiment as well. It actually rose this month for the first time since the end of 2021, and that has improved sentiment in home building stocks. By extension, that Spider S&P Home Builders ETF, which is what we're looking at here, has started off 2023 strong, up about 9% in January so far, which does put it on pace for the second best month in about 2 years, John.
Kelly Lights, thank you. The stock up by about 1.9%. Microsoft, the big one after the close. Guggenheim giving the stock its first sell rating in more than 3 years going into the print, saying this: while most investors see Microsoft as a large, stable business that can weather any storm, it does have vulnerabilities, some of which could be exacerbated by this macro slowdown. Ed Ludlow, that in the last couple of weeks ahead of earnings after the close.
Yeah, Microsoft is what we're bracing for because they're the first mega cap up. Fourth quarter earnings for information technology stocks on the S&P 500 forecast to drop by 9% from the same period a year ago, but that would be the steepest decline in profit or earnings since 2016. You know, Microsoft's top line growth at least was kind of the poster child of the pandemic era, but if we bring up this terminal chart, this is going to be the first quarterly top line growth that's sub 10% for a really considerable period of time, going back 22 quarters. So there is the one question, right, which you posed at the top, moving from the pandemic era of growth to a recessionary environment, how is Microsoft set to fare? We know they laid off 10,000 workers last week and that they'll book a $1.2 billion charge. As a result of that, that translates to a 12 cents hit to EPS when we consider the bottom line. That Guggenheim call, really interesting. It downgraded from sell to neutral on January 17th. It was the first sell rating on the stock going back 3 years. But this is just the start, John, of what I'm expecting to be a very long earnings season. And again, go back to your open. How does Microsoft fare in this environment relative to others? That's, I guess, the question and the benefit of going first this earnings season.
And mega cap tech results start after the close. Ed, looking forward to your coverage over the next couple of weeks, that's for sure. Morgan Stanley's Andrew Sliman looking for investments that could outperform in any earnings environment. He writes the following: if we have a recession, earnings are too high, soft landing, and earnings might be too low. It's a binary outcome. He goes on to say, so we like the areas already pricing in a recession and where central banks aren't tightening. We like the home builders and China. Andrew, I'm pleased to say, joins us right now. Andrew, buddy, good to catch up. Let's start there. The home builders. The home builders, why?
Well, look, you just mentioned it. Not a very good quarter and the stock's up. Why? Because they got decimated last year. These stocks are early cycle stocks. They're telling you that mortgage rates are going to come down in the future. So even though it wasn't a great quarter, this is why the stocks are up. So when you think broadly about the stock market in general, I just think you want to find companies that already reflect, not a great earnings season for 2023.
Well, we mentioned D.R. Horton. That actually bottomed last summer, I think, in June. The stock's up 50% since then. Is that a decent name, or are there better names out there?
Well, yeah, I think that's a very fair point. I would look beyond the initial home builders to some of the home furnishing stocks, because don't forget, consumer discretionary as a sector was down 37% last year. Consumer sentiment, according to the University of Michigan, hit an all-time low. And I think you want to move beyond. Well, if the home builders have started to recover, maybe that means home furnishing, home apparel, anything home-related that aren't up nearly as much. Those are opportunities I would look to, especially because they fall in that consumer discretionary group.
Andrew, can I just ask, who's going to be buying these houses? There's going to be a whole generation of people locked into 3% interest rates. They're not moving anytime soon. Where does that demand come from?
Well, rents. Look at rental income. I mean, rents are sky high right now. Now, the other thing to keep in mind is, yes, housing's turned down, but because new housing starts weren't able to be completed last year because of a lack of supply, there's not this huge glut of houses already built like we saw in 2008. So I think it's a very different situation. But again, remember, you have to think about what does these stock prices reflect, and I think it's a lot of negativity right now.
You mentioned China and China reopening. Europe certainly grabbing hold of that story and running with it. European equities on the Stoxx 50 close to up 10% year to date. The other question I have really is not what's happening in Europe and China. It's what's happening in the United States. I hear a lot of people say buy international, avoid the United States, it's too exposed to tech. Tech is absolutely ripping, actually almost keeping up with what's happened with European equities, Andrew. Why is tech running so hard?
Well, I think, again, it is a case of it got decimated last year. Look, there's no question in my mind earnings aren't going to come in great. But the key question is how much of that is already priced in from last year. A great little statistic, Jonathan. The last 11 times we've had a down earnings year for the S&P, the market was up 9 times, right? 9 times. So all that implies is stocks already reflected a down earnings year. This is why I think the NASDAQ is ripping. Now, I've got to say short term, be careful. because anytime you have a situation where the NASDAQ is ripping, going into earnings season, that's a dangerous scenario.
Andrew, I'm going through some of the cuts. We talked about them earlier with Peter Chier of Economy, just some of the job cuts out there at the moment in that sector. Some of it's brutal. Meta, 13% of the workforce, Salesforce, 10%, Alphabet, 6%, Microsoft, 5%. When you see that, clearly that's bad news for the people on the wrong end of it. For the stock specifically, Andrew, is that good news? Does that make a material difference?
I was shocked after third quarter earning, when I listened to the third quarter earnings season in October, how these companies were very, they didn't seem to understand the downturn in the economy. And I think they're coming to realize in a quick fashion, and I think this is one of the reasons why the stocks got hammered in the fourth quarter, and they're coming back because management is proving that they are willing to pivot off this perpetual growth, reign they've really been in for, over a decade.
We've had the valuation challenge. Fed funds has gone from 0 through 4. I get that. Have we seen the earnings challenge yet, Andrew, for some of these big names? I want to go back to that quote from Guggenheim. That first bearish call in something like 2-3 years on one single name. It was Microsoft, who said the following. This is Guggenheim. Most investors see Microsoft as a large, stable business that can weather any storm. It does have vulnerabilities, some of which could be exacerbated by this macro slowdown. We've seen the rates challenge. Have we seen the earnings challenge yet? Are we priced for that?
Yeah, I mean, those comments would strike me as perfect for what I heard out of third quarter earnings report last year. Are they, but now they're recognizing that they can't weather the storm, and they're making cuts to businesses that were less profitable. So I think the setup is actually, not bad going into earnings season because expectations are very, very low. So again, I just go back to these companies are pivoting and they're telling you, hey, no, we recognize we need to make adjustments to our business, and I think the market likes that.
So if I gave you a choice right now, just a final question, a choice between the cap-weighted S&P 500 or the Euro Stoxx 50, which one would you choose to hold for the next 12 months?
Well, the problem with the cap weighted is I think many of these big companies are coming under the thumb of the U.S. government that's going to slow their ability to make acquisitions and grow. That is a bigger story than earnings, which is, the Department of Justice is looking into these companies. And that, when you look back in history, that's always what brings down the biggest companies. That slows, they're knocked off their pedestal as the largest company. So I wouldn't bet on the S&P cap weighted versus European index. I might bet on equal weighted, but I'm not sure cap weighted.
Andrew Sliman on the latest. Thank you, Andrew. I want to head back to Abby just on that breaking news around the opening bell. Abby, let's go back there. What's happening to some of these halted stocks?
Yeah, it's really interesting, John, because that news came out and it was very different from what we usually see on the tape at that time. But stock after stock after stock, basically most NYSE stocks were paused for volatility. And as I had mentioned earlier on 3M, it showed a print of being down 16% in the first minute or so. So that suggests that there was some wild trading. But stock after stock from Nike, basically Occidental, they're all resuming now. So basically overall, NYSE has said that the trading, that they're open, that they've seen an unusual number of halted stocks. And on J&J, it's interesting because this stock in the pre-market had been up, it had been down, and now right around the time of the open, our internal Bloomberg system showed that it had been down for some range. Now it's showing that it had been up as much as 4%, and currently it's hard for me to actually even tell how much the stock is up. It looks like it's up just slightly at this point. And they, of course, put up a little bit of a disappointing quarter. They boosted their full-year earnings outlook. A bit of a surprise, John, of course, given the concern over the future of their COVID shot. The drug unit sales rose by 2.3% last year, but were up 4.3% without that COVID drug. The Street, their guidance had been for 2.4% or 2.4 billion or so. The range is above. Consumer health, the least contributing to the overall outlook. Pharmaceutical was the best in the fourth quarter, more than 50% of revenues. But again, this NYSE trading situation, we'll be watching it all day. It's really pretty interesting. It's also interesting, John, because you have been talking about this rally all morning. This stock, Johnson & Johnson, healthcare, those stocks are all down this year.
Abby, thank you. On the latest, on the breaking news and what's happening with J&J as well. The broader equity market, for what it's worth, for 15 minutes into the session, we're down about 0.5%. Coming up on the programme, another dose of optimism for the Eurozone.
We're seeing upside surprises in the data. This feared recession, the food and energy crisis, which was so talked about last year, is just turning out to be less threatening than expected.
That conversation up next.
We're seeing upside surprises in the data. This feared recession, the food and energy crisis, which was so talked about last year, is just turning out to be less threatening than expected. And so I think there's a very good case for Europe to at least outperform some of those really downbeat expectations.
Let's get you some breaking news. We can get that with Mike McKee right now. Hey, Mike.
Hello, Eric Robertson was right about upside surprises. We get that in the S&P PMI indexes for the United States, which just crossed, with global manufacturing coming in at 46.8, up from 46.2. The services index 46.6 from 44.7, and the composite index 46.6 from 45. So it looks like an upside move on all counts, except for the fact that we're still under 50. 50 for those. But different story in Europe. He was talking about upside surprises there. We got that for most of the indicators in most of the European countries. The French went down by just a tick in terms of the composite, but manufacturing was over 50. Services were basically unchanged. Germany did drop a little bit on manufacturing, but services went over 50 in Germany. And the Eurozone, in terms of the overall Eurozone, the S&P Global consensus there, 48.8 from 47.8 for manufacturing, and the composite 50.2, while services are at 50.7. So definitely a floor underneath all of the bad news in pretty much every category from S&P today.
Mike McKee, thank you. I'm happy to say that Guy Johnson's alongside me to talk about some of this. Guy, that's the first sub 50, or rather sub 50, north of 50 read we've had on the Eurozone composite going back to June.
Europe's got really lucky. Europe has got really lucky. Gas prices have come down really sharply. China has reopened. Everybody's getting hold of that narrative. The direction of travel here is really positive. In isolation, John, these are still fairly depressed numbers, but it's where we've come from. It's the direction of travel, and it's really positive.
The ECB emboldened to go 50, 50, 50?
Well, the third one maybe, but certainly the narrative over the last few days has been a fairly hawkish one. Yes, you've heard from people like Visco and Stunaras,
sure.
But they feel like they're in the minority right now. Yes, you would have thought, judging by current market pricing, that at least two 50s are bolted on. The Bank of England looks like it's probably going to go 50 today. UK data fairly depressed, but again, it's the direction of travel. And you take a look at some of the optimism indicators within this data, also fairly positive.
I've asked this question a few times this week. I'm sure you've done the same with your guests. Most people expect the ECB to hike more than the Federal Reserve this year. Are you hearing the same thing?
Yeah, but you've got to remember the ECB is playing catch-up.
Sure, to some degree, yeah.
So I think there is an element of kind of the timelines being a little bit sort of out of kilter. But
6
yes,
months
no,
behind.
it feels like the Fed's guiding us towards 25. It feels like the ECB is guiding us towards 50. Hence, you've gone from kind of a sub €1 to a, what are we, 109, and people talking about further upside to go.
I wondered whether the ECB could hike at all this cycle.
Yeah.
Never mind 50 basis points, 50 basis points, 50 basis points.
But we've come back, so a number of things have happened. You've been relatively lucky in terms of the economic data, so that has created the potential for more demand to come through, so the ECB is going to have to react to that. The ECB also is aware of the fact that in the Eurozone, just because of the regulated structure of labour, then potentially labour market data on the inflation front could be stickier. And they have, as Jean-Claude Trichet used to say, a single needle in their compass, and it is but one thing, and that is inflation.
Feels like the Bundesbank's back in charge over at the ECB. There is a fee for this guest appearance from Guy Johnson. The fee is a promo. Don't miss Guy Johnson's interview next hour with Chris Williamson, the chief business economist at S&P Global Market Intelligence. You happy with that?
Absolutely. He's the man that put the data together.
Looking forward to the programme, Guy. It begins in about 7 or 8 minutes' time. Let's get you some sector price action. We can do that with Abby. Hey, Abby.
Hey, John. Yeah, well, we do have the S&P 500 right now down about 0.3%. Not surprisingly, most sectors are lower, led by materials. We also, I just want to mention, have an update on that NYSE trading situation. They're saying that all systems are normal. They're not saying what happened, but it does sound as though they're admitting that there was an issue of some sort. But at this point, again, all systems are operational and normal. And then, John, I have a board for you that I have a feeling you are going to really like, because I know you like a board that shows a simple story. So if we take a look at what's happening year to date, it's extraordinary, this rally that you've been talking about with all of your guests this morning. The NASDAQ 100 up 8.5%. China Tech up 19%. But then take a look at some of last year's better sectors, the defensive sectors. Healthcare and staples, they are down. So this is the story. Growth is in, value out right now.
Abby, thank you. Stocks down 0.25%. Your trading diary up next. 25 minutes into the session here, equities on the S&P trying to recover. We're down about 0.2%. The Nasdaq slightly positive, up 0.1%. Over the next week, 25% of the S&P 500 reporting earnings. It really kicks off big time with Microsoft after the close. In the trading diary, not just that, President Biden meeting with top Democrats at 3 p.m. Eastern time. Microsoft, as I say, after the closing bell a little bit later. Results from Tesla, IBM coming up on Wednesday. U.S. fourth quarter GDP and another round of jobless claims coming up on Thursday. And finally, PCE numbers and the UMIT sentiment survey to round out the week on Friday. Live from London. That does it for me. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, January 24th. Here are the top market stories that we're following for you at this hour. A shot in the arm for J&J. Johnson & Johnson shaking off the dark cloud from the COVID-19 vaccine and painting a strong earnings picture for 2023. We're going to talk to Joseph Wolf, the J&J CFO. The U.S. slowdown slows. PMI still contract, but at a slower pace, while high prices stay a big problem. We're going to speak momentarily to Chris Williamson, IHS Markit Chief Business Economist, on better growth in Europe, weaker data
in the UK. And it's the big tech test. Microsoft reports after the bell its cloud revenue growth is expected to slow. We're going to see if the stock is recession resilient. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And Guy, I'm happy to say that the NYSE is reporting that all systems are currently operational. This is that a number of stocks were actually halted due to abnormal volatility. Okay, fine. But these were stocks like Walmart. These weren't like meme stocks.
No, we'll keep an eye on this. I don't think there's much more to take away at this stage other than all systems are go. Let's keep an eye on what is happening here. But I think in some ways this is emblematic, Alex, of an earnings season which I think is going to be bumpy, is going to be volatile. The market has pushed a lot of stocks a long way. Has the market taken those stocks too far, you could argue, in relation to the reality of the data, the earnings that we are about to see?
Yeah, and it's going to be really interesting to see also where the upside actually is. Do you have sort of that fear of missing out gets sort of turbo boosted after the PMIs into Europe, for example, and then we're going to be judging the earnings and the sales and most importantly the margins on a different kind of metric depending on where you sit in the world.
Yeah, arguably the PMI data actually point to a margin problem. So I think that is going to be something that we're going to have to discuss with Chris Williamson in just a moment. But as you say, in isolation, these data are not great. Even the European numbers aren't great. They're in and around 50. But it's the direction of travel that I think is important here. And you need to kind of break it out. You need to figure out what is happening with the individual component parts. Inflation, obviously, a major part of the narrative that we're watching here. So let's try and work our way through the numbers and the analysis. Let's start with the data first of all. Mike McKee's here to break it all down for us. Mike, what have we learned?
Well, we learned that things are not as bad as people anticipated they would be, and we do, as you mentioned, seem to be going in the right direction, even if we're still seeing signs of contraction. Not as bad as it was. Let's start with the United States. The latest number that just came in, the Richmond Fed Manufacturing Index, not part of the S&P Global ones, but it is one that people follow. That one's not so good. Down to negative 11 from a positive 1. So at least in that mid-Atlantic area, things are not great. But for the U.S. as a whole, the S&P Manufacturing Index goes up to 46.8 from 46.2. The Services Index, 46.6 from 44.7. And the Composite, also 46.6 from 45. So improvement, sequential improvement, call it. And we saw much the same in most of Europe, with a couple of countries in a couple of areas actually going over 50 to expansion, with French manufacturing and German services. The Eurozone as a whole, the Composite goes up over 50. So it's beginning to look like Europe is dodging the bullet. The UK, though, is the laggard here, the only one that really saw a significant decline across the board, and that's understandable given their economic outlook at the moment.
Mike, great roundup. Really appreciate it. Bloomberg's Michael McKee joining us there. Let's get some more analysis here with Chris Williamson, Chief Business Economist for S&P Global Market Intelligence. Hey, Chris, let's start with the U.S. for a moment. What did you make of the input prices? That was the first time we saw them up and growing since May. What's going on there?
Indeed, yeah, worrying time. I think we'd all anticipated that we'd see a further cooling of price pressures, but no, the rate of increase accelerated, and this is pretty broad-based as well, and importantly, feeding through to average selling price inflation as well. So what we've got here, it seems, is that while there's a lot of prices have been falling, we're now seeing wage pressures in particular feeding through to higher cost growth, and that is obviously not what the central banks are going to be wanting to see. So we've had, if you like, the big deflationary impact of those industrial prices cooling, and that's left us in a situation now where we've got the second round wage pressures starting to kick in, because a lot of those prices historically very high, and companies have been waiting to see when they can pass those historically high costs onto their customers, and it looks like they took that opportunity in January.
So if I'm an equity analyst and I'm watching this data, Chris, what is the signal? Is it that there is margin pressure, or that actually you can pass it on, some of this pressure, and top line's going to be basically outperforming the margin line? How should I be reading this? What, as an average company goes in the United States, what is the picture?
Well, perhaps this is the point you've got to watch, because they are trying to up their prices now. So what's going to be interesting to see is just how do sales and orders hold up in the face of those additional selling price inflation rates. They're testing the market, if you like. They've got this build-up of costs that they want to try to push on to their customers. So this is going to be an interesting period in the coming months to just see how well they succeed in that.
Mm-hmm. Well, Chris, that leads me also then to how the Fed's going to read the data, because if prices are still high, you're starting to feed through, say, to wages as well as what people are actually paying, and the demand is relatively there. That feels like the Fed's going to have to do more to crush demand.
Yeah, I think this is a pretty hawkish survey. Despite the fact that the output numbers are in decline, that rate of contraction has moderated. If you look at forward-looking gauges like new order inflows, business confidence about a year ahead, they've picked up quite smartly across the board. As companies are looking at the latest news flow and thinking, hey, it looks like there's not going to be a hard landing here. It looks like this is a soft landing, maybe no recession at all. And so they're sort of picking the ball up and running again. So I think the policymakers are going to look at that and say, hey, look, doesn't look like we've derailed things too much here by what we've done already. So can we afford to hike a bit more?
Chris, I want to talk about the European data. These are the composite numbers I've got up on the wall here. The January numbers significantly better than what we saw in December. The rate of change here is quite significant. The direction of travel here is worth bearing in mind. The Eurozone composite number coming through at 50.2. Now, in isolation, as I say, that's still a fairly depressed number, but the direction of travel is really impressive. Now, Europe has got lucky here. China's reopened, gas prices have come down. There's a lot of positive factors to bear in mind. Chris, is this a Eurozone economy that is early cycle? How would you define where we are?
Well, I think you've captured it nicely. We seem to be celebrating the fact that we're stalled, which reflects how grim things were looking a couple of months ago. More than anything to cheer, I think the fact that there's a soft landing, if no recession at all, is a really good picture compared to what we were seeing back in October, both especially in the Eurozone. It's more mixed in the UK, where current numbers are coming down further, and definitely risks of a Q1 GDP downturn in the UK, less so in the Eurozone. But even in the UK, you've got the forward-looking indicators coming up now, notably business confidence. It's the biggest jump upward in confidence about the year ahead that we had since the reopening of the economy in 2020. So even in the UK, where there's more pressures than anywhere else, arguably now, you're seeing this turnaround. Mm-hmm. So there could be a shift. But I do just want to stress that, there's so many headwinds that persist that I don't really see how we're going to really generate any significant noteworthy growth in Europe. Mm-hmm. If you've got policy tightenings coming through from the ECB still, from the Bank of England still, you've got governments looking to withdraw their subsidies from the energy crisis. I know the gas prices have come down, but when you start withdrawing those subsidies as well, what does this leave demand looking like? It's surely going to be coming under pressure. Quick
question then on prices, Chris, for UK and for Europe. If the US is looking at a stickier kind of situation and a pass-through, is that the same story for Europe and the UK in terms of pricing?
Interestingly, yeah, in Europe as well, certainly on that service sector side, things are looking a little bit stickier than we'd like to be seeing at this stage of the sort of general slowdown in demand that we've had. We would expect service sector price inflation to be coming down as those industrial prices feed through lower into things like food and transportation and so forth. But they're looking a little bit stickier. The reports we're getting is this is predominantly wage influence. Now, in the service sector, our input cost gauges include staff costs, and obviously those feed through to the selling price inflation as well, and that's where the stickiness seems to be.
China reopening seems to be being taken as a very good thing for Europe. What are you seeing in supply chains? Does the supply chain story that is improving continue to improve with that China reopening?
Broadly speaking, yeah, the supply chain situation has alleviated significantly across the US and in Europe. There's virtually, no net lengthening of supply deliveries in the major developed economies now, which is a massive change compared to what we were seeing this time last year. So that whole supply situation is eased. At the same time, we've got the demand situation pretty much collapsing. Companies are running down their inventory levels. They accumulated too much. So these twin factors are really helping ease the supply situation. We had a little wobble in some countries, which is perhaps linked to the additional restrictions in China that were in place before, but that seems to be alleviating now. So this reopening is, I think, on balance, a disinflationary impact for manufacturing globally.
Chris, always great to catch up. Instant insight into what the data are telling us. Chris Williamson of S&P Global Market Intelligence, thank you very much indeed. Coming up, we're going to turn to the markets. Earnings season starting to kick in. We're going to discuss what we are seeing with Elizabeth Burton of Goldman Sachs Asset Management. That conversation is next. This is Bloomberg.
Earnings season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Looks so much in the analyst earnings estimates like the fourth quarter was the recession, and here we are sitting in the recovery. And it actually looks a little bit like that in financial markets. And it would be wonderful if that were really the truth, if we weren't just on the leading edge of a hit that we're going to have in profits. And of course, how markets traded last year are not anticipating this to be, some kind of profit nirvana. We don't have 20% declines, without something.
That was Citi Global Wealth Management Chief Investment Strategist and Chief Economist Stephen Whiting earlier on Bloomberg Surveillance, which takes us to the question of the day. Is this the start of a, quote, earnings recession? You can take this many different ways. You can take a look at the PMI data that continues to slow, but less slow in those high prices. You can also take a look at the actual earnings, which you can get really hammered if you really miss. The consumer, no doubt, if you take a look at 3M, is really suffering. So let's get the insight now from Elizabeth Burton, Goldman Sachs Asset Management Client Investment Strategist. So are we facing facing an earnings recession?
I think we're going to see pressure on earnings for sure. I think this might look a little bit like a 2008 or a 2020 where we continue to see negative earnings revisions going forward, but I don't think that's a giant surprise. I think a lot of us anticipated earnings pressure going into the holiday season, the amount of discounting and sales that we saw on the retail side, and I think that's going to continue, that we're going to see companies struggle with passing through the margin increases, and it's going to translate into more difficult earnings scenario.
Right, particularly if you're exposed to the consumer, like I mentioned with 3M. Nevertheless, though, the equity market's done really well. I mean, I appreciate they were off by 0.2, but there's been a lot of money going into Europe as well. And is there like a FOMO thing happening, regardless of what the numbers tell us?
Yeah, that's an interesting way to put it, FOMO. I've been traveling a lot for the last couple of weeks, and the number one thing I've noticed when talking to investors is that there seems to be a very different risk appetite for our U.S. institutional clients and retail clients versus a lot of the rest of the world, maybe not the UK. And there seems to be some that are looking to put money back in, but on the U.S. staying much more defensive. We're not seeing a lot of flows into the public equity markets, maybe into the bond markets. And interestingly, one anecdote is that we're seeing lots of flows into EM equities, but I'm not hearing that from our U.S. institutional clients. So they're still sidelined. I don't know that they have that FOMO feeling quite yet.
What would it take for them to get that feeling? Good morning, Elizabeth. It's Guy.
Good morning.
European equities are absolutely surging. Emerging markets, as you say, having a very good run. At some point, aren't they going to be pulled off their hands? They're sitting on them at the moment. What is it going to take to get them to put them to work?
Look, I don't think there's any one trigger, but one way to get people to go back into a market that has been a little bit out of favor is to not have another alternative, sort of the reverse of what we saw the last decade. So when the risk reward becomes less compelling in credit and fixed income markets, then maybe people will look back to or institutions or investors will look back to the equity markets. But I think at the moment, at Goldman Sachs, we're assuming that a really good case this year will be flat on the S&P at the end of the year, right? So I don't think that's a super compelling reason to dip your toe back into the waters in the U.S. right now.
So based on that, if investors are de-risking and foreign investors are dipping their toes into, say, Europe, for example, what do you think it's going to take for U.S. investors to get more constructive?
It's an interesting point. I think one thing, at least on the institutional side, might be their strategic asset allocations and what their targets are. But again, sort of like how I said, if there's some bumps in the fixed income markets or credit markets, there certainly will be bumps in the credit markets going forward next year, right? We've had a little bit of a Goldilocks scenario. There will be certain companies that have a difficult time with the higher cost of capital. Same thing on the equity side. In the fixed income markets, I think that there's been a lot of bond buying lately. It's been certainly quite an interesting month, but I don't think the full story has played out on the Fed. It looks like we're going to get 3 increases and then a pause, and that's certainly Goldman's base case, but we can't quite be certain because we still haven't seen the troughs in the equity markets that we really need to be sure that inflation has completely cooled, right?
True.
Elizabeth, let's talk about that from a tech perspective. Tech got beaten up early on. There's a number of different factors, but one of them certainly was what we were seeing on rates. Rates racing higher completely changes the valuation model, the discount model for the tech sector. Yet since the beginning of this year, it has been on fire. Tech stocks are surging. Can you walk me through your thinking around that and whether or not that's something that people should be getting involved with?
Look, for now, I think that we believe that there's still value to be had in value stocks, and long duration stocks like the tech sector have certainly been challenged. That doesn't mean that they will forever be challenged. We do think there'll be an opportunity to get back into those markets. I think that we're more focused on the type of stocks that can really take advantage of this new economy and these new trends that kind of came out of COVID versus the old economy and what we all knew were the popular new hot things, 5-10 years ago. So, as always, if you have an edge in those markets and you think you have something to play, by all means, but I think we would still for the moment tilt towards the value side.
So, which raises a good question. At what point then does tech become value? So it's like the head mess, right? And then is energy still, for example, a value stock, a value play?
Yeah, that's interesting. And I guess if you're thinking about it from an asset allocation perspective and you have those buckets to fill, that might be more of the question that I would be asking. Mm-hmm. But for now, I think I would be thinking about what sort of stocks can really pass on through these increases to the consumers. And to your point, I think that energy can. Certainly some parts of the tech sector should be able to do that. Those with really sticky customer bases and, tools that you and I can't live with every day. And then there's other parts of the spectrum that we've seen, a lot of headwinds behind recently that may play out. But I don't know that reclassifying any stock from one to the other makes it a buy case.
Okay, well, fair enough. And then let me take the question to the broader asset allocation in terms of value. How much do you anticipate interest picking back up into Europe? Like, how sticky is that flow going to be, considering that we've had so much interest over the last decade plus in the U.S.?
Well, look, I think the dollar might play into that. We should see a peak in the dollar later this year, and that should provide somewhat of a tailwind for ex-U.S. assets. I think Europe's a tricky place because with China coming back online and some of the energy pressures, it might be a little bit difficult, but there will be opportunities there, again, on the value side, and different parts of Europe and regional parts of Europe. I think in general, with China coming back online, we want to look for countries that are commodity exporters. Maybe that takes you to other regions of the world. But I do think this might be a major inflection point for country divergence. And if you're looking for diversification in your portfolio, I think you kind of have to look ex-US, which is not a situation we've been in for the last decade. We've really been okay just sticking close to home.
Right, and not all EM is also like China or the same. Elizabeth, thank you very much. Elizabeth Burton of Goldman Sachs Asset Management. Appreciate your time today. Guy?
Bit of breaking news over the last couple of minutes. We've been building up to this over the last few days. Huge pressure on Berlin. It looks like, and we've been given the maybe early heads up on this, it looks like Germany later today or maybe tomorrow, more likely, will give Poland the okay to re-export the Leopard tanks that Poland originally bought from Germany, from Rheinmetall, that were made in Germany, exported to Poland. Poland now looks like it's going to be given the green light from Berlin to export those tanks to Ukraine. Obviously, this is these are the tanks that Ukraine wants. They are reasonably well used across Europe, therefore parts and everything else are reasonably available. They want the heavy tanks. The UK has already gone down this road. It looks like we're about to see Poland going down it as well. Up next, we're going to go back to what is happening with the earnings story. Tech taking a breather in some ways today, waiting for Microsoft. Microsoft kicking off the earnings season for Tech later today. Results, remember, out after the bell. We're going to discuss what we should be watching in the startup. That's next. This is Bloomberg.
Like Bloomberg.
"7 on the West Coast. We're a little late, but it's still time for the startup. The tech world is holding its breath today, basically waiting for Microsoft after the bell this evening. What should we be looking for? Ed Ludlow joins us now from San Francisco. Ed, give us the highlights.
Yeah, so Microsoft goes first, right? And if you look at information technology stocks on the S&P 500 in the last 3 months of 2022, the forecast is for EPS to drop by 9%, which is the biggest drop since 2016. For Microsoft, they fare a little better. Consensus is a drop of around 7.5%. But look at this terminal chart, right? You have to go back 22 quarters for the first time that Microsoft had top-line growth below 10%. Top-line growth this quarter round is expected to be around 2%. This is Microsoft's fiscal second quarter, but the calendar fourth quarter of 2022. And of course, we want to know how they're going to fare going from this pandemic growth era to this kind of recessionary environment. We know they laid off 10,000 people last week. That will materialize in the form of a $1.2 billion charge that translates to a 12 cents hit to EPS. So a lot to look out for this evening, but we're bracing.
And also quickly, we got Elon Musk again at court yesterday. How did he fare?
Yeah.
How did he do?
He kept his cool, but he basically said unequivocally Saudi Arabia's public investment fund was committed to a deal to take Tesla private. There was little documentary evidence of that, but he also recalled dinners with Larry Ellison, Goldman's Dan Dees, SoftBank's Masayoshi Son, and he tried to paint a picture of this being in the works for some time, despite there being any concrete binding agreement. But he kind of doubled down on what we've been talking about, right? The idea you should not fully take his tweets at face value as it relates to the volatility that spooked investors, resulting in this trial.
All right, Ed, we're going to catch up with you on the cable later, too, so we're going to get all the dirty details there. Ed Ludlow joining us. All right, coming up back to earnings, you got pharma giant J&J seeing higher full-year earnings. We're going to talk to the CFO, Joseph Wolk. This is Bloomberg. an hour into the U.S. trading session. We're trading a little heavy here, but a lot of earnings to sort through. Also, the data from about an hour ago showing the price pressure still very much remain here in the U.S. Abigail's tracking those moves for us. Abby?
Yeah, so there is a little bit of a dent here, Alex, in the three-day rally that we have. But I will note the S&P 500 still above 4,000, but down about 0.4%. This, of course, as those earnings that Alex was talking about are weighing to some degree. In fact, let's take a look at what's going on. It's not about technology. Of course, we have Microsoft and Tesla coming up, but we have 3M down 6.4%, the worst day since August of 2022, I believe, having to do with a weak outlook. They also laid off 2,500 people. Union Pacific down 3.3%, a disappointing profit there. Danaher, their outlook for profits disappointing. And then Verizon turning it around despite the fact that their forecast is off too, so we'll be digging into that. Now, relative to the S&P 500, it is above 4,000. It is above its 200-day moving average. So there is reason to think that it could go higher, or this cloud, basically a conglomeration of different moving averages, suggesting we might just be going sideways at this bear market, and this would actually set up possibly a strong bull market over time, that it's going to stabilize into some sort of a sideways trend. But if it's above 4,000, the longer the S&P 500 stays above 4,000, probably the less chance of some sort of drastic drop later this year that some folks are calling for. Not to say it couldn't happen, but there may be reason to think that it would not. And then one earnings winner on the day, a little bit of a mixed quarter relative to the quarter itself, but for Johnson & Johnson, last time I looked, the stock was higher. The outlook is better. The street had been at $10.35 billion, and now the range is higher than what the street was looking for. Guy.
Abigail, nice setup. Thank you very much indeed. Perfect to lead us on to our next conversation. Let's get some more insight into Johnson & Johnson and the results that have just been delivered. We're now joined by the company's CFO, Joseph Wolk. Joe, great to talk to you as ever. Thank you very much indeed for spending some time with us today. Let's talk a little bit about where you are taking this business and where you're going. You talked about and these were the words of the call, I think. They kept coming up and up. Responsibly cautious. That was your kind of summary of the guidance going forward. If I'm an analyst and I'm looking at, therefore, what you're saying today, can I assume that all of the bad news is kind of in what you've told us today, and from here things only get better?
Well, Guy, it's a pleasure to be here with you and Alex today. You know, I would say that what we're trying to do is strike the right balance anytime we come out with guidance. And so we're trying to take those risks and those opportunities and say, hey, this is a fair projection of what our business is. In terms of where we're taking the business, though, we couldn't be more excited. In addition to the financial performance that we had, better than 6% growth across the entire portfolio in 2022, we made a number of significant enhancements, progressions with our pharmaceutical pipeline. Our medtech business acquired Abiomed, which was a $16.5 billion acquisition to put us in a high-growth cardiovascular market. And then the consumer business had a very, very solid second half, which positions them well for the separation. So I would say the guidance, while we're using words like prudent and responsibly cautious, it's really speaking to, it's a balanced assessment of risks and opportunities that we know today.
For the margin pressure that you see, when do you feel like it bottoms?
That's a really good question, Alex. Right now, in terms of our guidance, we experienced a lot more inflation than we were speaking this time last year throughout the course of 2022. Some of that gets hung up on the balance sheet and inventory, and then will flow through our P&L throughout 2023. Right now, and maybe this is one of those responsibly cautious elements, we're not assuming any deflationary relief. So in terms of inflation, we think it's here to stay. We'll see some of it through our P&L, at least for the balance of 2023, where we believe costs will remain as high as they are.
Joe, are you setting us up for an outlook upgrade later on this year? Feels like it.
I sure hope so, Guy. I mean, that's always our goal, to have aspirations that are above the expectations of the current day. But again, I'll come back to, if you look at just all the macroeconomic uncertainties, you were just speaking with your previous guest about potentially an earnings recession. We're certainly trying to avoid that. We feel very good about the 4% plus that we're offering today in terms of an EPS outlook, as well as a top-line outlook, amidst a lot of not only macroeconomic uncertainty, but some geopolitical uncertainty as well.
Joe, going back to the margins for a moment, where do you see the stickiest cost pressure? What was surprising about the eco data today was that businesses are really starting to pass along those higher prices in the services sector, and that's really hard to reverse. Where are you seeing it, and what's your pass-through?
Yeah, so throughout 2022, Alex, we saw it in some materials, but mostly they were packaging materials, some contract manufacturing, and the wages associated with those types of services. I would say those are the areas that we see. In terms of pass-through, being in pharmaceuticals, being in medtech, the space of healthcare really doesn't give us the opportunity to pass those along. We have taken strategic price increases in our consumer unit consistent with what that marketplace has been doing. But we're very limited overall into what we can take in terms of price. Matter of fact, our growth is largely volume.
In terms of let's just focus on the top line for a moment.
Sure.
In Europe, there feels like there's considerable pressure at the moment to reduce healthcare costs. Are you feeling that? Are Europeans pushing back? Is that what you're getting from governments over here right now?
Yeah, very astute, Guy. We actually saw some of that in the fourth quarter. We saw some austerity measures in some of the major countries with respect to our pharmaceutical performance. We think some of that will continue on into 2022. We also see volume-based pricing in China, specifically in our medtech business. We are the largest player in medtech in China, and so that obviously has a disproportionate impact relative to some of the other competition in medtech.
Yeah, so to that point, and I feel like the way we're dividing this interview unconsciously is I'm really focused on pricing and margins, and Guy's really focused on that top line. So I feel like they may come together when it comes to China. How do you view the reopening in terms of your devices unit?
Yeah, no, that's another good question. So we are projecting right now, what we said in the call is we expect the second half of this year performance to be better than the first half, and likely the second quarter to be better than the first quarter. Some of the rationale for that is the lingering effect from the surge of COVID in China that we experienced in the fourth quarter that hurt performance a little bit. We think that'll linger into the early part of 2023, but then get continually better. Now we are hearing some things in terms of reports on your network that maybe China's opening up a little bit faster than we expect. That would be one of those balanced upsides that maybe could portend, but we'll have to see how that plays out.
I'm not saying she's wrong, but let me just break with Alex's model. And let's talk about the consumer spin
okay, great.
That is coming up. Do you think, Joe, that you've got your arms fully around what the cost structure around this is going to be, what it's going to cost to do this spin? And do you think there's an opportunity? Why are you doing it now? Do you think if you waited, you might get better value for that business?
Yes, you're always going to be subject in a transaction like this to what capital markets will do, but we feel really good about where we are with respect to the process. The first year, 2022, is really spent on developing a company within a company, so this business is ready to run on its own. Now it's a matter of the capital markets equation and how we go to market. On January 4th, we filed a Form S-1, which enables us the opportunity to go with an initial public offering at the outset. Again, we'll need capital markets to cooperate, but the brands and the strength of this business, as you saw in the second half, we think sets up well. We'll have to see how it plays out, and there's not a lot we can say due to regulations being in registration, but we're on track for what we conveyed in November of 2021, and that's to separate this business throughout the course of this year.
Is there anything that you feel like you need to do in the consumer brand to help that case?
I wouldn't say help that case. First of all, I want to be very mindful of the registration process and the regulations around that. But what I will say is maybe go back to why we made this announcement to begin with, and that is just a very different business model and different criteria for success in the future. If you think about how we used to advertise in consumer products for healthcare, we often relied upon 5 years ago 9 out of 10 dentists, 9 out of 10 dermatologists. Today, it's much more likely that a Kardashian social media post or a Jennifer Aniston social media post has a lot more influence. And so if you look at the heavily regulated, heavy investment R&D landscape of med tech and pharmaceuticals, it's very different than what's required in consumer products. Again, these are very important products. They help people live better daily lives, but it's just very different in terms of how you're going to be successful in the long run.
Just to come back to the calendar, so the spins this year, you're working through the regulatory process as we speak, hence you can't tell us as much as maybe you would like to. When do you think that process comes to conclusion and you can kind of tell us everything? When's the Capital Markets Day? When are you going to be able to divulge all of this information, do you think, Joe?
Yeah, I'll stick by the statement, Guy, that we plan to separate the majority of this business by the end of 2023, based on our current timelines.
Hey, Joe, it's really good to catch up with you. We appreciate it. Good luck with that. We'll get you back on as that process evolves. Joe Wolk, Johnson & Johnson CFO, thank you very much. Hey, Guy, we have some breaking news for you. Another hawk out there for the ECB, continuing with half a point rate hike increase. You're looking at an ECB governor commenting in an interview, Simkus, looking at another 50 basis point hike. So yesterday we got, what, 6 hawks? 2 neutral or 2 doves. Now we got the 7th hawk here.
Yeah, there do seem to be a fair few hawks. There are lots of members on the Governing Council, but it does certainly seem that the data are moving in their favour right now. Today's PMI data, there's inflation in there. The direction of travel is much more positive. This should allow the consumer to feel more positive about what is happening, potentially spend a little bit more, make that inflation stickier. All of this is pointing in the direction of at least 2 more 50s. That certainly seems to be the guidance coming from the ECB.
Yeah, or at least maybe there are more hawks, but the hawks are definitely chatting. They're definitely the chattier group at this moment. All right, coming up, we're going to go back to earnings here. You got GE shares are up today. The travel rebound boosting growth prospects. I'm still worried about the energy transition, though, in their renewables business. We'll also talk about 3M. We'll speak to an analyst who is bullish on GE, Dean Dray of RBC next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Bloomberg's learned that Germany is expected to give Poland it's okay to send its German-made Leopard tanks to Ukraine. The approval could come as soon as Wednesday. German law requires approval for the re-export of its military equipment. That means the hundreds of Leopard tanks in Europe can only be sent to Ukraine with Berlin's consent. In Half Moon Bay, California, police arrested the suspect in another mass killing. 7 people were killed and 1 was wounded at 2 plant nurseries. The 67-year-old suspect was believed to have been a worker at one of the locations. Meanwhile, an 11th person has now died from the shooting at a dance hall in suburban Los Angeles. The suspect in that shooting killed himself. In the UK, there's more evidence that the economy probably has slipped into a recession. British companies signalled that output has dropped at the fastest pace since the start of the pandemic. Meanwhile, the government's budget deficit rose to a record. Soaring interest rates have jacked up the cost of debt service. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Alex.
All right, Ritika, thank you very much. Let's get to earnings updates here. 2 major industrial names out with results today. You got manufacturing giant 3M. They're cutting 2,500 jobs, forecasting profits below Wall Street estimates. It was pretty ugly, that Post-it guy. All right, and GE is seeing profits below estimates due to its issues in its renewable energy business, which they're trying to spin off by the beginning of next year. Joining us now, Dean Drey, RBC Capital Markets analyst. He covers both companies. An overweight rating on GE, price target of 93, underperform on 3M with a price target of 113. Dean, I mean, the renewable energy business down 19% in terms of revenue. That's not great. Do you think that Larry Culp's really going to be able to turn this around before the spinoff, and how does he do that?
Yeah, Alex, so the pressure on renewables is not a new development. This has been a work in progress since the day Larry Culp arrived at GE. They're resizing the business. He's introducing lean manufacturing. There's still a lot of cleanup of the portfolio to do. The expectation is renewables, despite all of the demand that everyone sees on the energy transition, the renewables business, wind in particular, will be money losing through 2023 and the break even in 24. That's just the reality of what the setup is for the year. It was not a big shock to anyone, but that's the outlook.
Dean, GE is rapidly becoming just a jet engine business. It has come a long way. It has whittled itself down to essentially that. When I think about the jet engine business, though, I'm looking at an incredible recovery in aviation right now. I'm looking at airlines bringing back, I think Lufthansa's bringing back some 340s, some A340s, which I thought were long gone to the desert. I'm assuming that old engines need more servicing, and as this recovery continues, that is great for GE.
Yeah, Guy, that's exactly right. There is a unprecedented ramp going on in aviation. We're seeing it everywhere. Takeoffs, landings are about 90% of where we were in 2019. Airlines are scrambling to meet this demand. You are seeing some older planes coming back, put into use. That is all good news for GE, which their services side of aviation makes higher margins on the services side, and older engines need